Beijing surrenders as angry homebuyers threaten to break the banks and the financial system. I'm your host, Steve Van Metre, and thanks for joining me today. And last week, we reported that angry homebuyers in China were stopping payments on unfinished homes. And initially, the government had no response. But over the weekend, with the financial system under threat, well, they had a change of heart. Let's over to Bloomberg, where we picked today's story up. As China mortgage boycott data erased by censors as crisis spread, and shared documents, social media posts are being scrubbed online as Beijing tries to make this go away. And shared files managed on platforms including China's core equivalent Zhihu Inc. and on sites like KDocs and Walleye have been banned following reports that a number of homebuyers refusing to pay mortgages surged in a span of days. GitHub, a popular file sharing site for coders, remains as a source for people to post documents. Lenders have said the bad housing loans are controllable, but the spike in incidents is fueling concerns that the property troubles, which have largely centered on developers following a government crackdown on excess leverage, will engulf big banks and China's middle class, who have an estimated 70% of wealth stored in real estate. And this is a huge issue because we know here in the United States, we've seen this happen before. When people stop making payments on their loans, well, you have these little things called financial crises. And now China's setting up to be the epicenter of the next one. And Beijing's finally decided that perhaps this is not something they should let get out of control. This is a political protest, according to chief economist at Endo Economics. It's not going to be a banking crisis. Well, at least it's not yet. But they are not there. That in a crisis potentially of confidence, and one of that the Chinese Communist Party fears tremendously. And Chinese authorities held emergency meetings with major banks this week to discuss the home loan snub on concern that more buyers may follow suit, according to people familiar with the matter. Some lenders plan to tighten their mortgage lending requirements in high-risk cities, two of the people said. Now imagine that. Here you have an all-out kind of crisis starting to brew, and the bank's response is like, yeah, well, I think we'll just tighten things up a little bit. And you think the response here doesn't make a lot of sense, but that's what happens when the banking system knows that eventually the government will step in and bail them out. And banks are rushing to reassure investors that risks are contained, as lenders have detailed 2.1 billion yuan of loans at risk. In most cases, the overdue amounts make up less than 1% of the lender's total mortgage portfolio. However, GF Securities expects as much as 2 trillion yuan of mortgages could be impacted. Now, why are banks trying to run out and say everything's okay? Because if people lose confidence in the banks, who have lent out more money than they have, and then all of a sudden depositors say, hey, wait a minute, I'm concerned about my money being good here, and you start pulling deposits, well, the entire banking system goes to collapse. And eventually, well, just like during the great financial crisis when the Fed steps in, governments tend to bail out the banking system, and for good reason. Without it, well, the economy would just blow up. And China waives mortgage grace period to appease angry homebuyers as officials consider temporary waivers after payment boycott. No surprise. Under a yet-to-be finalized proposal from financial regulators, hundreds of thousands of buyers of stalled homes would be allowed to pause mortgage payments with no impact on their credit scores, the people said, asking not to be identified discussing a private matter. The plan is part of a broader push to stabilize the property market that includes urging local governments and banks to plug some of the funding shortages at developers. While a payment holiday could backfire if it encourages owners of completed properties to also protest for relief after home prices slump, regulators are calculating the move is necessary to inject confidence into the market and to buy time for developers to complete projects. Homeowner eligibility and the length of grace periods would be decided by local governments and banks. And the stakes are high for Xi's government as homeowners and investors. About 70% of the country's household wealth is stored in property, along with 30 to 40% of bank loan books, while land sales account for 30 to 40% of local government revenue. The mortgage boycotts have roiled Chinese stocks, heightened stress in the country's credit markets, and dragged down commodities from iron ore to copper. And this just isn't a story about the Chinese housing market. This is a story about the global economy that is slowing down, and the fact on top of that China's got parts of its country locked down in part of its COVID-0 policy. And when you do that, well, the economy is going to slow, and lo and behold, housing prices are going to fall, and now they have this contagion risk that is looking to spread into an all-out financial crisis. In a worst-case scenario, the issue could trigger a systemic financial risk and social instability, giving housing's role as a bedrock of the broader financial system. Policymakers are likely to act quickly to contain this emerging crisis. And just like during the great financial crisis, the Fed stepped in to bail out the U.S. banks, the money creators, the money centers of our financial system. And almost with no surprise, we're starting to see Beijing surrender as they fear that this could get overdone. And of course, even if Beijing does fully capitulate, it doesn't mean the housing market can't blow up there and take down the rest of the global economy with it. If you're concerned about what that could mean to your portfolio, well, you shouldn't be. There's one strategy that loves deflation and is currently hedged against it. That's Portfolio Shield. I'll put a link up here in the corner and description below because it's one of those few strategies that actually go up when things go wrong. Let's continue on because things here in the U.S., well, aren't looking so great after all, as Morgan Stanley sees stock losses even if there's no recession, and odds of recession continue to rise with week's jobs data. Let's head over to the Morgan Stanley trade desk, where they headline the defensive leadership can continue as earnings cuts begin, even though that's not the consensus view. While defensives are the clear leader, most investors aren't there, leaving more upside potential as earnings cuts begin. Countertrend rally may continue, but make no mistake, we don't believe this bear market is over, even if we avoid a recession, the odds of which are increasing, something we've talked about on the show and made the case for. But let's continue on to see what Morgan Stanley has to say. Recession odds continue to increase, with bond markets joining the policy, as the Morgan Stanley recession model is now at 36% and approaching the peripheral red line, historically speaking. Other warnings include rising jobless claims, which we pointed out, and falling job openings, something we've also pointed out, albeit from extreme levels. With profit growth likely to fall sharply over the next several quarters, the risk of a labor cycle is increasing in our view, and this is the only metric we think matters for whether we enter a recession or not. And they point out their red line for recession inevitability is just over 40%, and right now it's at 36 and getting very close. So what Morgan Stanley says is a sure bet of a recession. And they show that consumer sentiment, something we use on this show frequently, is a leading indicator. They have unemployment rate shown inverted, and you see here in dark blue, sentiment leads a rising unemployment rate, again shown inverted. It shows that jobs plentiful, less jobs hard to get, tends to fall. It shows the JOLTS here in light blue, it goes down, which we've also made the case. And of course, that means we're at levels closely associated with recessions. The step into earnings season consensus expects approximately 5.5% earnings growth in the second quarter, driven particularly by positive sector contributions from energy and industrials. Consensus is calling for strong top-line growth, but margin headwinds. Change in net margin is expected to be negative on a year-over-year rate of change and detract from overall earnings per share growth. That said, this margin pressure dynamic is expected to be short-lived, and margins are expected to contribute positively to EPS growth post-second quarter. We're skeptical on this front, given the myriad cost pressures companies are facing, coupled with decelerating demand risk. But there's two factors that I'm wondering if you're thinking about right now, because there's two factors I'm thinking about that have a major impact. We've talked about it on the show before. One of those is the Fed's balance sheet. The second is the dollar. Let's take a look at some of these charts and see where earnings are likely headed. Now, on the Fed database, they don't have earnings. They have corporate profits after tax, which is good enough, because if earnings are going down, well, profits are going with it. And sure enough, here we have the monetary base, or the Fed's balance sheet, on a year-over-year rate of change in red against corporate profits after tax in blue, also on a year-over-year rate of change. And here we note corporate profits likely lagging, of course, the Fed's balance sheet lower. How about the dollar? Well, when the dollar gets stronger, here we're showing it inverted. We've got a little minus sign in front of it on the nominal broad dollar index in red. As the dollar gains strength, well, that drives earnings and profits down. So in my book, it seems like we're going to see earnings to the downside. Of course, what we don't know, well, analysts water their estimates down, so we still get an earnings beat and encourage more investors to keep buying into this market. But let's talk about now whether the U.S. economy is doing, because last week we got the U.S. factory output. It declined for a second month on consumer goods as a manufacturing production dropped 0.5% in June, matching May, and total industrial output fell 0.2%, the first decrease this year. And to get a better insight on this, let's head over to our own chief strategist, Jeff Snyder. But before we get there, I was on Emil Kalinowski and Jeff Snyder's show last week. I'll put a link in the description below. We were talking about bonds and why it matters, or maybe it doesn't matter, what it means when foreign investors are buying or selling bonds. If you haven't heard about this, well, be sure to check that show out. But let's continue on with Jeff's research, because while you're in there getting that link, there's also a link to access Jeff's reports for a limited time. They're free, and check that out, Markets Insider Pro. And here we go. Before 2016, every time industrial production would decline on an annual comparison, a recession would soon follow if it wasn't already happening at the same time. The exceptions, Jeff says, was 2015 and 2016, where he says Eurodollar number 3. Now, just for your help, whenever Jeff says $3 or a number, he's referring to a period of dollar shortage. So he's talking about how there's a period of dollar shortage led to a decline in industrial production, and this is key. And 2018 and 19, which he marks as dollar shortage number 4. To this rule of thumb are technical. While the American part of the global economy didn't qualify for recession, it was very close by early 2016. In 2019, it's likely there would have been a full recession before COVID, but we'll never know for sure because of COVID. So he said, why would industrial production endure as such a dependable macro signal in a radically changed world? Well, he says mainly the goods economy, unlike services, is more cyclical. When rough economic conditions and negative pressures materialize in labor and then consumption, or consumption and labor, consumers and businesses will be the first to cut back on their purchases of goods or materials. The robust correlation to general downturn recognizes that in the industry where we can see distress coming first, where contraction pressures must be severe enough to make a difference in the specific data. So he says when industrial production declines on a sustained basis, there must be something wrong, and seriously enough wrong that we can expect the global economy as a whole to go wrong soon enough. And of course, if you're following his research as I am, he already has pointed out that we are in the next global dollar shortage. Again, you can read all about this in his daily briefs and his deep dives. Get on that link in the description below, because where is industrial production heading? When we overlay the U.S. stock market, as we talked about, the U.S. economy is a function of the U.S. stock market. Here we have the Wilshire 5000 in red on a year-over-year rate of change, a leading indicator to industrial production, in blue on a year-over-year rate of change, suggesting that as the equity market goes lower, well, industrial production is headed with it. And sure enough, we're more likely to be in a recession, on top of the fact that we're stuck, as Jeff Snyder points out, in one of the worst dollar shortages that he's seen. I'm Steve Van Meter. Thanks for watching. Thanks for being fans. Bye now.